Wells Fargo gets a new CEO as banks report earnings, the consumer is still alive, and Alcoa disappoints. This time on the Morningstar Weekly Wrap. The scandal over unauthorized accounts being opened at Wells led to the CEO stepping down this week. Sinegal has his take on the news and on third quarter bank earnings.
The big news this quarter from an investment point of view is that Wells Fargo's customers are not leaving in droves. Despite all of the media attention around the sales scandal, we actually saw Wells adding customers. Customers are borrowing, mortgage originations are up, deposit balances are up, and we're to some extent not surprised as the issues affected only a small minority of accounts. We like Wells Fargo stock a lot right now. We think it's a great opportunity to get a high quality stock at a discount to our $62 fair value estimate, and Wells is yielding 3.4% as well, so the dividend should provide a bit of downside protection and makes the stock more attractive. Otherwise, it was a great quarter for the banks. They're not yet firing on all cylinders, but they're getting closer. The energy lending problems earlier in the year have dissipated as oil prices have gone back up. Customers are borrowing, auto lending is good, credit card lending is good. JP Morgan gathered a lot of customers, and it was a great quarter for investment banking. We saw the big investment banks, JP Morgan and Citigroup, record large increases in revenue there. So a lot going right at the banks, not much to worry about outside of Wells, and even there they seem to be taking care of their problems.
Retail sales rose 0.6% in September, rebounding from a disappointing August. This data was in line with expectations, just that the consumer is alive and well. Given the importance of consumer spending to overall growth, this is welcome news given other parts of the economy are showing signs of slowing. Alcoa had disappointing results, and Andrew Lane doesn't think that the stock price decline this week has left the firm looking attractively priced.
Alcoa shares traded more than 10% lower after the company's third quarter earnings release on Tuesday, October 11th. In our view, the primary driver of lower share prices was the fact that management cut its guidance for the company's value-add segments. These segments service a wide variety of industrial end markets, including aerospace, automotive, transportation, construction, and packaging. For the upstream or commodity-facing side of the business, we forecast lower long-term aluminum prices, as spot prices are currently about 15 to 20% above where we think they'll ultimately settle. Our long-term aluminum price forecast is largely predicated on the view that aluminum demand growth in China will decelerate from current levels, and it also reflects the fact that there's a lot of new low-cost supply coming online in China. So even though shares plummeted after the earnings release, we actually see a little bit more downside from here, as our fair value estimate for Alcoa is only $23 per share.
And in case you missed it, Alec Lucas took a deep dive this week on the American Fund's offerings that are now available without a commission on the Fidelity and Schwab platforms.